Hi there, welcome, welcome, welcome. It's a great day to be connecting today. My name is Lunta Di La Paulo. I'm gonna be your host tonight, as many other nights that I have been. I am really thrilled to be here tonight to be presenting to you on a very important subject. I promise you this is gonna be very remarkable to you because this is one of the topic that whether or not you are a small business owner, this is going to be very close to your heart, right? And as one of the very famous quote that says, there are only two certainties in life, right? Taxes and death, right? Today, we're going to be talking about one of them. That is not death, that is not dying. We're going to be talking about taxes, right? My goal with today's live is to give you 7 tax strategies that can help you reduce your taxable income the remaining of this year, right? So if you implement some of the items that I'm gonna give you tonight, you're gonna be in a better position to reduce your taxable income by the time the tax season comes around, okay? But before I do that, I'm gonna be giving us a little bit of a walkthrough so that we have the right type of information, okay? So I have written this ebook that I'm sharing here in front of me, right? This ebook, I have written it a while ago, and we have written 10 tax strategies to help business owners, right, save money on taxes. This is not to say that some of the strategies here are not to be used by individuals who are not business owners. So this is really designed to help you understand what does it take to save money on taxes. Okay, so even though we're going to be talking about 7 out of the 10 tax strategies, right? This ebook, this guide is available to you. If you want it, reach out to me. I'm gonna send it to you a free copy, or someone from my team is gonna send you a free copy. Okay, so we're really gonna spend a lot of our time looking into this tax guide, okay? So before we start talking about the 7 tax strategies that I shared with you, if you are on my distribution list or my mailing list, you should see, or you should know about the seven the seven the 7 tax strategies that we'll be covering, okay? But if you're not, right, if you're not part of my distribution list, then just bear with us today, and you will be able to get these I'm gonna cover one by one these tax strategies, excuse me. Okay, so before I get there, let me talk about, okay, how the tax landscape looks like in the US today. Let me tell you about what are we seeing, okay? What are we seeing in terms of who's paying taxes and by how much? So far, we know that 90% of small business owners, and by the way, in the US, small business can be defined in many ways. But according to the SBA, the Small Business Administration, right, small businesses are they can be businesses depending on the industry that can have up to 500 employees or 100 million in revenue, right? Depending on the industry. But for our purpose and practice, right, we tend to think of small businesses as businesses generating up to $2 million in revenue, in profit, excuse me, and up to 10 million in revenue. These are the type of small businesses that I usually work with, that I spend a lot of my time engaging with. That's not to say that I don't have clients, or I haven't engaged client with revenue profitability levels beyond this threshold. Certainly I have. But for the purpose of this illustration that we're sharing here, right, the small businesses we're talking about are the type of businesses that generate around $2 million in profit And these business owners are overpaying taxes. That's according to the data we have about individuals paying taxes. But we also know that 99% of multimillionaires and billionaires are paying, on average, 5% less taxes than the average American family, right? So that might not seem like a big deal, but when we are thinking about the ability for you to save money for retirement, for travel, to reinvest in your business, that becomes a big deal, because if you spend a considerable amount of your money paying taxes, right, that you could have otherwise reinvest into your business growth, or otherwise invest into your retirement, or even diversifying your holdings by investing in other assets, then you're really losing a lot of value, right? So what does that even mean, right? So if you're paying, more tax than you should have been paying, but just think about it. An average American spends about 30% of their income in taxes, right? So you might be a little bit shocked, but that's the truth, right? On average, we're paying around 30%, because that includes the federal income tax, that includes the Medicare and Social Security taxes. If you live in a state like me, Illinois, where we have state income taxes, that's also another burden that we have to give. And if you live in a state with sales taxes, right, and other property taxes, and many, 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 many other taxes, right, 30%, it's actually a conservative number, right? So really to think about that, right? In practice, a lot of people are spending about 1/3 of their life working just to make money to pay taxes. All of us, we've encountered situations where people are telling us, I don't want to work more than I am happy now, because if I work just a little bit more, the IRS is gonna get a bigger cut, right? So, in a way, taxes can create disincentive for people to work. But the truth is, you can make a lot of money and still keep a lot of that money if you know how to reduce your income tax legally. Again, you don't have to commit fraud. You don't have to lie. You don't have to, you know, do sketchy things, right, to try to save money on taxes, because that's not how things are designed to work. Okay. Here's an important point that I wanna raise here, and I wanna make sure that, right, that here's an important point that I wanna mention to you here, is the fact that, very often we get so carried away with conversation around taxes that we don't really think about taxes in our normal day-to-day life until the tax season comes around, right? But for you to save money on taxes, you need to kind of enter into the government's mind and think about what government thinks about in terms of rewarding or not rewarding in our market system, right? Because the tax code is essentially a system for rewards, right? It's the government telling us, hey, if you do XYZ, I will give you some benefits. I will give you some breaks. I'm gonna give you some loopholes. I'm gonna give you ways to reduce the amount of money you pay on taxes if you follow what I'm telling you, right? But if you don't do those things, I'm not gonna give you those other benefits, right? So let me give you an example. The recent global, or at least in many Western countries, there has been a tremendous push towards cleaner energy, right? Renewable energy, solar energy, things like that. What's happening? We are seeing a growing, right, government interest in providing tax credits around solar homes, solar panels, clean energy, and electric cars, vehicle, right? So That's because the government wants to shift behaviors, wants to influence how we behave, right? And the way to do that is for the government to create some form of incentives, right? In markets, in economies where people don't necessarily, right, have a market system like ours in the US, right? Many times taxes don't even matter. Why? Because, there is an elite that have ownership and concentration of almost everything, and the rest of the population lives in a large informal market, right? As a consequence, there is a very small tax base that the government can actually pursue to collect taxes on. In the US, that's the opposite. We are a more organized society. We have a system for accountability, or at least we tend to think about our system this way. So the government really have an incentive to creating, right, mechanism to incentivize people in terms of what they want to see happening in our society, right? Another example about how our government loves to create incentive is around business ownership. The government wants us to create businesses, to grow these businesses, to hire people. That's why there are so many benefits. I'm gonna give you an example, and we're gonna talk about it in a few minutes here, right? For someone who works for a corporation and they are not the owner of that corporation, when they pay their health insurance, they are not able to deduct this health insurance as as an expense on their tax return. But a business owner can deduct that expense on their business return. Why that difference? Because the government is seeking to reward and encourage certain behaviors. That's at least how I tend to think about it, right? Most of life, I tend to see it as a game of rewards, right? A systems of rewards. So here I showed you how about one third of most people's working hours is really dedicated to paying taxes, right? So that if you put it into perspective, you spend about one third of your life just to paying taxes, right? I don't want to to blow it out of proportion, but in a different time, right? That could be taken in ways that may not look appropriate today, right? But before we get, let's keep moving. All right, let's talk about how your income gets taxed, right? There are three types of income, and each one of these type of income gets taxed differently, right? First of all, we have ordinary income that the vast majority of Americans earn today, right? Most people work for somebody else, right? I have employees, I have a team. I pay them ordinary income, a salary at the end of the year, or around somewhere in January, they receive a W-2 they use to file their tax return. Okay, that type of income gets taxed the most because you're paying the federal income tax at your respective tax bracket. You're paying the Social Security taxes, the Medicare taxes. If you live in a state that have income taxes, you're also paying that, right? And if you live in a locality, right, for example, in Michigan, if you live in East Lansing or Lansing and many others counties and cities, now there are also taxes at the local level, right? Many of them are 0.5%, others are 1%. My guess is these are gonna continue going up, right? So for people who live in locality or are looking to move in different states or in different cities, you really need to think about the tax implications of moving just across to across to another city, another town, or another state. Okay, make sure to do that. All right. But also, us as business owners who are running the business, we are generating ordinary income, right? Because we're working on our business, in our businesses. we are creating value for society, but we tend to get a better side of the deal, right? I'll put it that way. We tend to get a better side of the deal because we can move things around, we can be a little bit creative and minimize our tax liability or tax burden without breaking the law. The second type of income is the passive income, right? If someone invests in my business, or when I invest in somebody else's business, or you invest in somebody else's business, that you don't have to work there, right? That you don't have to, roll your sleeves and, go there every day or every other day to produce, right? And a very common way of people, getting or obtaining passive income is investment through real estate, right? Syndication or real estate funds or private equities and so forth. That's a passive type of income. And we think about portfolio income, which is the third type of income that I'm describing here, that is derived largely from securities, right? Bonds, stocks, ETFs, all these type of things are going to be, your portfolio type of income. I have to mention here, that each one of these income is going to have a different level of tax incidence, right? So if you are seeing my screen here, you can be, you should be mindful that when we look at ordinary income taxes, you can easily go from 30 to to 40% of your income staying on taxes, just like that. Passive income, it's possible to reduce it to 0% fairly well. Portfolio income, you can get capital gain taxes that also work favorably for you depending on your tax bracket. You can pay zero tax on that income, or it can go up to 20%. But as everything else in our system, they are really good exceptions, right? For folks who are in private equity, there is this notion of carried interest, right? That is effectively an ordinary income, but there is a loophole there. They get taxed at capital gain tax rates, right? It's incredible, 20% up to 20%. So if you want to reduce the amount of money you pay on taxes, instead of just launching a regular type of business, launch a private equity, launch a hedge fund, right? It's an easy way for you to actually reduce your money without having to think about a lot of complexity, right? So let's talk about how or why the rich pay less taxes in the US, and the 95% of business owners overpay on taxes, right? So look at the wealth distribution. These are the data from UBS. And we are seeing that the top 20% of the US hold about 77% of income, right? And then middle class is holding about 21%. And then the bottom 20% are holding about 2% of wealth in America today. And American families are holding about $100 trillion in wealth. That's a massive amount of wealth, right? And the rich are continuing to get richer and paying lower taxes. But here's what I need to disclose here, right? Paying lower tax rate doesn't mean that they aren't paying taxes, right? Doesn't mean that they are not paying, their fair share. There is a lot of discourse out there, putting people against one another, right? There is a lot of millionaires. I have friends, I have clients who are in that category and bucket. They pay hundreds of thousands of dollars in taxes, right? What, for some people could have been a year worth of salary. They're paying that entirely on taxes. So let's try to to be a little bit more objective. Okay, let's try to be a little bit more objective. So back to our conversation, the rich get richer essentially because they have mastered these three items, right? They hold assets, they have an army of advisors to help them get ahead of the curve, and they use leverage, right? Not all the time they are using their own money, their own resources. They are using leverage, and the benefit of leverage is that it's tax deductible, right? If you have a personal credit card and you buy a lot of stuff, the interest you pay on that credit card, excuse me, is not deductible. But someone who buys a business, the interest that they are paying on the debt piece of that business acquisition is deductible. Of course, there are certain rules around how much can be deductible for above certain threshold. But in general, right, for small businesses, the interest is entirely deductible, especially if you structure that deal in a way that gives you a lot of room for interest only payment. You can actually save a lot of money that way in taxes, right? So that's really what's happening here. And I wanna give you now the example around the seven tax strategies that you can use, right, to help you get ahead of the tax season, right? So number one is the startup and organizational tax deduction, right? So this is one of these things that a lot of people do incorrectly, right? When they launch a business, they just write off everything. That's not correct. That's not correct. That's not following the rule, right? If you get audited, some of these expenses may be recategorized so that you can and you'll get penalized for that. So it's really important to follow the rules and learn how to use the rules for your advantage in your favor. Okay. So the startup and organizational tax deduction expense tells us that we can deduct up to $5,000 in startup and another $5,000 in organizational expenses, right? And any amount over that should be amortized for 180 months. Okay. So the tip here, best practice here is you really need to keep your startup expense below $5,000 and your organizational expense below $5,000, right? You maximize up to $10,000 that you can write off exactly in that here, because any amount over this $5,000 and that other $5,000 will need to be amortized, right? Deducted for 180 months. So it's a long time to wait. So do yourself a favor, just keep those expenses below the 5,000. And I have here an example. When you get your ebook copy, right, you can actually see the example and apply it for your own context. Okay. So that's number one. The second home office deduction is the tax strategy is the home office deduction. This is one of these items that some accountants have a pet peeve, right? They're afraid, they're scared, they don't want their client to claim this supposedly because they're gonna get audited. But my friend, that's not the case. If you follow the rule, you have nothing to fear, right? And personally, I like to mention these to my clients, especially my clients who use their home, a piece of a part of their home to run their business, right? I run a completely virtual accounting firm, right? And when I travel, right, I make sure, we're gonna talk about travel deduction a little bit. My apartment, my overseas place, whatever it is that I use to live, I always separate a place that I use exclusively for business, right? Exclusively for business. That's very important, right? A place that you use exclusively to run the business, to do client work. You don't have to receive people there, but it gotta be a place, a dedicated space, right? If you could see my workspace right now, you would clearly see that this is a workspace. This is a place that somebody comes to work every day, right? It's my office, you know, it's separated to the rest of the of my home, right? And therefore I can deduct any mortgage payments, any interest payment, any liability payments that is allocated specifically to this portion of the house, right? I can this is, by the way, the actual approach, right? If you use the IRS approach, which is the simplified approach, you write off 5% per square feet, and the IRS says you can only deduct up to 300 square feet. That's it. You don't get any more, right? So at maximum, you can claim up to 1,500 using the IRS method. I don't like it, right? Because typically we're paying more for our property, for the garage, for, you know, the place we store documents, the utility, internet, and so forth, right? We want to make sure that we are actually taking advantage of that. We are taking advantage of that, right? And the key here, again, you know, I have worked with clients that, you know, they just love to be in water. They were in the financial advisory space, and they wanted to attract wealthier clients. You know, it made sense for them to buy a boat and park it in Chicago, you know, Lakeshore, right? So that became a business expense, and they would receive a lot of the client in that, you know, boat house, so that, you know, they will share the right messaging to their clients, and that helped them increase their client base really quickly, because they could organize event in that place. They could host a lot of clients that would come to their office on the lake, right? Very exciting, very interesting idea, right? That was used as technically, you know, their home office as well, right? So there aren't really limitation around how to use that. If you have an RV on your front lawn that you only use for your business, guess what, my friend? That could potentially classify as a home office deduction, right? So, but we need to pay attention to the type of entity that you are. If you're a single member LLC, or a partnership, or an S corp, or a corporation, right? They are different rules on how you can claim these accurately on your tax returns. Okay, so I'm gonna move to healthcare. Right, this is one of the area a lot of people actually leave money on the table. Right, most people today don't even file their tax return using Schedule A. Most people today are, in fact, using standard deduction, excuse me. And for those using Schedule A, right, you can only claim the portion of your healthcare expenses, the portion up to over 7.5% of your adjusted gross income. So that's a big problem. Imagine, right, if you spend $10,000 in healthcare expenses in a given year, right, and you earn an income of $200,000, right? And that's let's say your just gross income is, you know, 175,000, right? So that essentially, let's bring it a little, let's make it a little bit more realistic. Let's say your adjusted gross income is 150,000 after your other Schedule A adjustments, right? What's happening? What's taking place here, right? So you have 10,000 in Medicare, in healthcare expenses, but you have adjusted gross income of 150,000, right? If we put that into perspective, right? If we put 150,000 times 1.70 times point 0.075, right? That's 11,000. So all the 10,000, because your 10,000 is below 11,000, you don't claim anything, right? But if you were a business owner, we could structure that in a way that becomes tax deductible to you, right? There are a number of strategies, right? And, we can think about, your HSA approach. We can think about your health reimbursement arrangement approach, right? We can think about, a health plan for your organization that can help you save money on taxes while providing you and your family and your employees, if that's the case, a decent healthcare protection, right? That's our strategy number three. Strategy number four is vehicle. Vehicle is fantastic because they provide us the benefit of depreciation, right? When you buy a fixed asset, even though we are in a phase out, years, the bonus depreciation is being reduced and gradually, phasing out, but it's still there. Depreciation, is one of the key miracles in real estate for those who invest in real estate. So it's very important to understand that when, you purchase a vehicle, but the problem that I've seen with vehicle as a tax strategy is that people make a lot of confusion and make a lot of mistakes. They will buy a vehicle to be used for the business, and then a little while, after a year or 2 years, they're gonna transition it as a personal vehicle, essentially making them lose the tax benefits and or opportunities they could have been getting from here, right? So very important to consider vehicle as an area to get favorable uh, tax benefits here, right? Because everything you're using towards your vehicle, if you use it for business purpose, it can be deductible, right? It can be deductible. Excuse me. And the number five tax strategy is travel. If you arrange your travels in a way that makes sense, you can actually get them tax deductible, right? So there is a little bit more detail here in the ebook because of time, right? I'm starting to move a little bit faster here. The next area of benefits here for you is actually retirement, right? Retirement provides today there is a lot of vehicles that you can use or type of retirement plans that you can use that can yield you amazing tax savings, right? Amazing tax saving. And that's just another item. And the last item is hiring your family members, especially, for those of you who have children below 18 years of age. It's amazing what you can do when you hire your children and put them to work for your business. It can be a major wealth creator for your children. It can be a way for you to help your children save for not only their retirement, their college education, their future wedding, their future business, and so forth, right? If you are a parent and you hire your children, besides the financial side, you're giving them a practical skill set that will help them throughout their life. Okay. So I've been trying to keep these lives around 30 minutes, and we are a little bit past that 30 minutes here. So I'm gonna pause. But if you have any question, please reach out. Let us know. We're here to help you. The ebook is available for those who would love to get a copy, and we're here to help you. We are a CPA practice. We're based in Chicago. We run a completely virtual practice, right? A lot of our ideal client is someone we can work with a CPA on a virtual basis, right? Every year and there, I would meet, someone for coffee, for a meal. We will talk a little bit, but generally, I only meet with my clients online and remotely. Okay. I hope this was helpful to you. If you found this valuable, please share. the video, like, leave a comment. This help Facebook, LinkedIn, or other social media to identify this as an important and valuable content so that their algorithm can share with more people. Okay. Thank you so much for your time tonight, and I hope to see you next Thursday, exactly 5:30 Central Time, and have a great rest of your day. I'll see you soon.